Insurance companies are pulling out of California at an alarming rate, and it's not what anyone expected. While homeowners celebrated finally getting into market, a financial earthquake was building beneath their feet. How big is the impact here if insurance becomes unaffordable? It could be devastating. In fact, I saw this one quote from a housing policy expert who says, "We could see the greatest housing displacement in California since the 2008 financial crisis." See, the mainstream narrative says California's housing market is stabilizing and costs are coming down. But that's not what's actually happening across the state. So why are home insurance premiums for millions of Californians about to explode by 300% or more? Why are homeowners in fire-prone areas facing the biggest financial devastation? And if you're living in California right now, paying for insurance while trying to afford your mortgage, what does this mean for you? Very real for families because renewal season is here. Here's what they're not telling you. California's insurance crisis isn't just failing homeowners. It's setting up the biggest housing collapse since 2008. And according to leaked industry documents and data that was never meant to go public, insurance companies know it. They're quietly exiting the market because the moment wildfire risk accelerated, they realized California became uninsurable. And the Golden State, once the dream destination for homeownership, is about to become ground zero for a mass exodus. Right now, homeowners are opening their renewal notices and seeing that their insurance premiums are set to double, triple, and in some cases even quadruple, if they can get coverage at all. If you're one of the 2.4 million California homeowners in high-risk fire zones, you need to understand what's about to hit you. Major insurers like State Farm, Allstate, and Farmers have stopped writing new policies. And the California Fair Plan, the insurer of last resort, is about to become overwhelmed. Starting this year, your home insurance costs are about to double, maybe triple, because insurance companies are refusing to even offer coverage in entire zip codes. In Los Angeles County alone, State Farm dropped over 72,000 policies. The average home insurance premium has jumped from $1,200 a year to over $4,000, and that's if you can even find coverage. For a family making $120,000, that's an additional $2,800 in annual insurance costs, about 2.3% of their entire income just for basic coverage. It is painfully clear that insurance companies are not listening to California homeowners because what families statewide are saying is, "Please don't abandon us and make our homes uninsurable." California leads a nation in insurance market disruption, with as many as 2.7 million homeowners potentially losing traditional coverage when major carriers complete their exits. And here's the kicker. Most of them just bought their homes in the last 5 years, paying record prices. More than half of California homeowners in fire risk zones purchased their properties between 2019 and 2024 at peak prices. They stretched to afford these homes, and now those same homeowners are about to get financially destroyed by insurance costs they never anticipated. Around 1.5 million homeowners are projected to be forced into the Fair Plan next year because they can no longer get private insurance. Some real estate experts cannot open their mouths without saying California's housing market is collapsing. Maybe that's why state lawmakers are more serious about avoiding the insurance crisis debate than they have ever been about affordable housing. A new poll found 67% of California homeowners and 71% of recent buyers actually favor state intervention to stabilize insurance costs. Homeowners across the political spectrum want help, but Sacramento won't act decisively. State regulators are willing to let millions of homeowners face financial ruin to avoid confronting insurance companies who spend decades lobbying against reform. About 6 in 10 homeowners with insurance in high-risk areas say they would consider selling if their costs doubled. That's working-class families in the Inland Empire, Central Valley, and mountain communities who suddenly can't afford to stay in homes they just bought. They are scared their equity will evaporate and scared to face a market where no one can get insurance. But here's where the story takes a shocking turn. While the insurance crisis devastates California homeowners, state lawmakers just handed the housing market the biggest shock imaginable. Governor Newsom and California legislators have proposed new wildfire mitigation fees and building requirements that could add $50,000 to $100,000 to home construction costs in fire zones. Newsom made his position clear. If you want to build in California, you need to build safe. Safety costs money. The most radical measures will require all homes in fire risk zones to meet new hardening standards. Sounds reasonable, right? Here's the problem. A new UC Berkeley poll shows Californians are split almost evenly on who should pay for wildfire mitigation, with no clear consensus on solutions. These building requirement changes hit in 2025, the exact same time millions of Californians are getting crushed by insurance premium increases that the state failed to prevent. You think that's a coincidence? One of the reasons that this crisis has not yet caused complete market collapse is because homeowners are bending over backwards to stay in their homes. Yeah, someone is definitely being bent over here, but it's not the insurance companies. Political and economic insiders know a secret most people don't understand. You often see housing markets collapse months before it's obvious. Something occurs. A policy fails. Costs spiral out of control. And by the time mass foreclosures begin, the outcome was already decided. We saw this in 2008 when subprime mortgages collapsed. Banks expected to weather the storm. Instead, the entire financial system nearly failed. Overall insurance costs will go up 340% in some counties. Housing affordability was the issue that propelled California's housing crisis to national attention in recent years. The state failed because it couldn't protect homeowners from insurance companies. And now it's happening again, but this time it's worse. It is the 1 in 4 California homeowners who are getting screwed by this insurance crisis. 1 in 4. About 2.7 million fewer Californians will be able to afford traditional home insurance if the market continues its current trajectory. By 2030, 4 million California homes could be considered uninsurable by private markets. More than half of those affected live in Riverside, San Bernardino, Sacramento, and Shasta counties. Northern California and inland areas saw the largest growth in home ownership after 2020. When people were buying homes, their entire investment was rooted in this idea of building wealth and stability. Buyers thought they could manage the risk, budget for insurance increases, make them stretch a little further financially. Except it completely backfired when insurance companies started pulling out of entire regions. When people who need affordable insurance were asked who deserves the most blame for the crisis, 44% said insurance companies and 31% said state regulators. Just 18% blame individual homeowners. Even recent buyers know who's responsible. Not only has the cost of insurance, property taxes, and maintenance risen, probably why some wealthy Californians decided to offload their properties and move to states like Texas and Florida. They knew once the insurance crisis accelerated, the cost of keeping their California homes would just be too much to bear. California state legislators from swing districts are panicking. They're in purple areas that voted narrowly, districts with high homeownership rates, districts where insurance premium increases will devastate their constituents. And they know what's coming. California has 52 congressional seats. Democrats control most of them, but several districts are vulnerable. Districts in fire-prone areas. Districts with high recent homebuyer populations. Districts where voters are about to get hit with massive insurance increases and property value drops. Then vote in November 2026 with that financial pain fresh in their minds. California's new insurance regulations will cause 750,000 to 1.2 million homeowners to lose access to traditional insurance in 2025 to 2026, with coverage loss concentrated in Los Angeles, Riverside, San Bernardino, Sacramento, Placer, Shasta, Sonoma, Napa, and San Diego counties. Every single one of those counties, critical to California's housing market. I think California lawmakers are really going to pay for this in the next election. There are a lot of middle-class homeowners in this state, and especially right now when housing affordability is terrible, people need stability. Insurance costs will rise for most of the 15 million homeowners who have policies. A family with a $700,000 home making $150,000 will pay an additional $3,500 in insurance premiums for coverage in 2025. Watch what happens when you multiply that across millions of families, all getting bills in January, all furious. By November, homeowners in high-risk areas will face higher deductibles and out-of-pocket maximums. A family could pay an additional $10,000 in wildfire damage repairs that insurance won't cover. If the insurance crisis continues and state intervention doesn't happen, we'll see even more people who are starting to list their homes for sale or walk away from mortgages just trying to survive financially. About 7 in 10 homeowners said they've heard just a little or nothing at all about the full scope of the insurance crisis. They have no idea what's about to hit them, but they're about to find out. Renewal season starts now. That's when millions of Californians open their mail to check their 2025 premiums and see costs that double or triple overnight. The California Department of Insurance announced it would allow insurance companies to use catastrophe models that project future risk. These models justify even higher premiums and more denials. That's California's solution. Let insurance companies charge whatever they want based on worst-case scenarios. I'm hopeful that at that point, legislators will realize this is a crisis, that California homeownership needs to be accessible and affordable, and they'll come to the table. Even state officials know this is an economic disaster. A small bipartisan group of lawmakers introduced legislation to create a state-backed reinsurance program, keeping private insurers in the market through 2026. Why? Because state legislators are terrified of voter backlash. According to sources who've seen internal Democratic strategy documents, the party knows they're facing a disaster. Polling shows homeowners across the political spectrum are angry. Data shows middle-class areas getting hit hardest by premium increases. Models predict massive property value drops in formerly desirable areas. And every projection points to the same conclusion. Housing affordability and insurance costs will dominate California's 2026 elections. Some legislators are saying they don't want to see home insurance costs triple for millions of Californians. And frankly, this will impact every resident. Real estate groups and consumer advocates are demanding action, arguing that homeownership shouldn't become impossible for the middle class. They're pressuring lawmakers to act. But state legislators in competitive districts, they're begging leadership to pass emergency measures because they know what's coming. Insurance industry analysts projected that if the crisis continues, home values in fire risk areas will decrease by 15 to 25% by 2027, and 4 million California homes could become effectively uninsurable through 2030. Those aren't abstract numbers. Those are voters. Angry voters who just lost their biggest investment. California went blue in 2024, but California's legislative seats in 2026 are about to see massive upheaval. Subscribe for more updates on how the insurance crisis is transforming California's housing market and political landscape.